Hello, everyone. This is the Free American Press, their host, Alexander Horat. Today, we're having a very special guest on the show. Again, my mom, her name is Maria Horat, and she's a real estate broker in California. And today, we're going to talk a little bit how the Federal Reserve is going to be raising interest rates by half a percentage point for up to 7 times this year. But before we get into it, if you could please subscribe to the channel and leave a like on the video, that'll be really appreciated. So, hello, Mom. Could you tell the viewers a little bit about what you think of the Federal Reserve is doing?
Yes, thank you, Alex, for having me on your show. And we see in this month that the Federal Reserve has already initiated a 0.25% increase on the interest rates. But just today, they announced that a 0.25% might not be enough to fight the inflationary trend that's taking place. So they're thinking that is going to be probably about 0.5 percentage point, which will definitely have a very, very negative impact on the housing market. I wanted to just share my screen to show the article that just was on this afternoon. And by the way, after the announcement, of course, the Dow fell 202 points. And at the National Association of Business Economics conference, Powell said that the Fed is prepared to lift the benchmark lending rate in increments of 0.5 percentage point rather than the standard 0.25% point going forward. The Fed lifted the rate by 0.25 percentage point, which is the traditional way to increase it this March, and indicated that there will be 7 hikes this year and more after. Now markets are on the edge and that the central bank will be more aggressive than that as it tries to tame inflation by curbing economic demand. So whether they're bluffing or not, it definitely is having an impact already, as we can see with the stock market.
So what do you think that basically the Federal Reserve raising interest rates, what do you think that'll do to the housing market?
Well, the National Association of Realtors and CoreLogic have predicted that the value appreciation of homes this year was going to be only in the single digits, as opposed to the last couple of years that have been double digits. So they had already predicted before this was announced that there was going to be a slow on the market. However, now with this announcement, and if that's really true, which if they're announcing it, they're probably very desperate for doing something with inflation, or they're just really trying to scare people. So it's not the first time, of course, that we've seen high interest rates. If it really starts reaching new high levels, but we've seen that in the 1980s, it was almost 20%, 18.5%. And that was, sustained for a while. And then the interest rates, and then we see inflation also in the 1980s, right here, these gray portions are recessionary periods. Inflation reached 13.5%. So while interest rates were at almost 20%, the inflation rate was at 13.5%. Can that happen again? More than likely, yes, because we have seen what we talk about, quantitative easing, taking place quite a bit more in the last few years, especially since 2008, where they have been printing money out of nothing, just actually less than nothing because it's backed by debt. And that just generates inflation and hyperinflation.
So do you have a graph on how this affected the real estate market in, say, the 1980s when they did all this?
Yeah, well, in the 1980s, home values were, the average or the median home price was only $64,000. So the effect that it might have had was very minimal. But, we've seen that how the housing market has increased.
It looks like it's been really steady. The housing market.
It's been very steady. It's been ups and downs. Up here we had a 2008 housing bubble first, and that wiped out about 30% of the household, the average household net worth. A lot of people were left without homes, lost their homes. A lot of people were upside down with their mortgages, meaning the mortgages were was more than what the house was valued at. So more than likely, you know, if there continues to be a shortage on supply, you know, and the high demand, of course, there's a lot of demand for housing. We have high record levels of shortage. We'll probably have a sustained period still at best that might just still be stable for the remaining of this year. But if the Fed really starts doing what they're saying, we're probably looking at some tough times ahead for the housing market beginning next year.
Yeah, it appears that the housing market has just been going up with inflation.
Yes. And actually, I wanted to talk to you a little bit about the devaluation of the currency, which we also seen. Let me just share my screen again. And we know that under a transitory inflationary trend, the real estate has been considered a hedge against inflation because the effect on debt, as the money is not, the inflation can be equated with a decrease on the money's buying power as the money's buying power decreases. So that's the debt, even though if it's fixed with a 30-year mortgage, it will be less and less as the time goes by because of the buying power of the dollar decreases, which has a benefit to the homeowner because then after 15 years of making mortgage payments, it won't seem like it's a whole lot of money. As you know, as you see, for example, that the rents have gone up quite a bit, and that if you can find a rental available. So when you compare that with the rate of inflation against that, it has some advantages. And we see that also has a benefit to the income potential for investors. However, because we're benefiting for a short amount of time on inflation doesn't mean that we should support these monetary policies that cause transfer of wealth from the middle class to the elites. So what is currency devaluation anyway? Currency devaluation is a deliberate downward adjustment on a country's currency value. We've seen that taking place here with the US dollar. And we've seen how that has taken place in countries like my home country of Venezuela, where the exchange rate is something like around 55,000 bolivars per dollar, has the highest, the currency over there has devaluated the most out of all the countries in the world. And they also have the highest debt per GDP and also the highest inflation rate. So the question now, what is currency devaluation impact on real estate? And for that, let's first turn to this graph provided by Visual Capitalist, how the purchasing power of a dollar was in the 1920s. Right after the Federal Reserve was founded in 1913, we see a sharp decrease on the value of the dollar. I want to actually read just a short paragraph from G. Edward Griffin from The Creature of Jekyll Island, which I think is fantastic, but really explains it in a way that people can understand. The accepted version of the history is that the Federal Reserve was created to stabilize our economy, to help the people. They had the Ponzi scheme going on in the early 1900s, which involved also the bankers. So one of the most widely used textbooks on this subject says that it sprang from the panic of 1907, with its alarming epidemic of bank failures, as the country was fed up once and for all with the anarchy of unstable private banking. Even the most naive student must sense a grave contradiction between the cherished view and the system's actual performance. Since its inception, it has presided over the crashes, several crashes. In 1921, as we can see clearly on this graph, 1921, 1929, Great Depression that lasted until right before the Second World War, 1939. In 1953, 57, 69, 75, 81, a stock market Black Monday in 87. And of course, we know about the housing bubble crash in 2008. So we see how there has been a systematic devaluation of the currency since the Federal Reserve Bank was formed. So what does it tell you? That's
Yeah,
what we
it
have to ask
basically
ourselves.
tells us that since they got rid of the gold standard, the dollar has been going down quite substantially.
Yeah, because as they have the fiat money, which is backed by less than nothing, backed by debt, they also, one of the things in their agenda is to get rid of the gold standard. And US President Roosevelt criminalized the possession of gold in the 1930s, which Americans were the only ones who couldn't buy gold, but everybody around the world was able to buy gold at $35 an ounce. And all of a sudden, the US also became the US dollar became the world's reserve currency. And in the Bretton Woods Agreement, which basically was a group of socialist elite members that got together and they formed the IMF, which is basically what the Federal Reserve Bank is to the US. And it's basically just a world's bank. And the goal is to, according to G. Edward Griffin in his book, he talks about extensively about that agreement, was to get rid of gold, even though they wanted to first look as, the gold standard was still going to be okay for a little longer. They abandoned it shortly after. But basically their goal was to have a one world bank to later establish a one world order that the world will have to follow. Then the gold standard was abandoned and currencies are no longer linked to gold. Then of course we see the quantitative easing, which is the fancy word for just fiat money, printing money out of nothing, that begins in response to the financial crisis taking place here, the 2008 housing bubble crash. And the US money supply grew by $3.8 trillion in 2020, equal to 20% of all of the US dollars ever created. So they printed massive amounts of money also right after, during the pandemic to help the economy. But that's, created all kinds of problems as we see now.
Yeah, that's basically inflation is a tax because, they put in 20 new % of dollars ever created, and they gave it to only a few people in the stock market who own huge mega corporations. The rich got richer, the poor got poorer, basically because they gave all that money to the rich people and it didn't trickle down to the poor people. So it really was a tax on everybody else's wealth because it devalued everybody's dollar so they could have more money.
That's exactly right. And we see the effects of hyperinflation and currency devaluation in other countries like Venezuela. That's just one. And I like to bring that one up because, of course, that's where I'm from. But we see here a picture, which is a very famous picture of basically explains itself. In order to buy one roll of toilet paper, you need this amount of bills, Venezuelan bolivars, in order to buy this amount of paper. There's more paper here than there's here. So that tells you, people just can't afford goods and services, much less real estate. The value of real estate in Venezuela was wiped out by 70%. 90% of the population is very poor. But there is one advantage of currency devaluation for some people, some groups, and that's foreign investors. As the inflationary trends continue to go up, and as we continue to have currency devaluation in a country, there is also a lot more investors from foreign countries purchasing real estate. That was seen in Venezuela as a property boom gets fueled by US companies, even though Venezuela had an unstable political regime and a history of seizing private property. And it would seem an unlikely place for US companies to buy commercial real estate. Companies, American companies like DirecTV, cosmetic makers like Avon Products and Marsh have been snapping up office buildings there. They have been building a lot of buildings and malls, and the reason Venezuelan ban on money leaving the country has stuck foreign companies with no way to get their cash home, as accelerating inflation and the threat of currency devaluations risk eroding the value of cash holdings. But Venezuela is not the only place where this has happened. We see that happening here too. Foreign investment in the US commercial property exceeds pre-pandemic levels. Foreign investment in US commercial property surpassed pre-pandemic levels last year as overseas investors piled back after travel restrictions eased and the US economy bounced back. Pensions, sovereign wealth funds, and other foreign institutions purchased $70.8 billion of US commercial real estate in 2021. That was the highest total since the $94.6 billion invested in 2018. And investors coming from Canada, Singapore, South Korea, and the UK, and other countries. China has been having their own problems with their real estate and their own economic issues, so they haven't been a major, according to this article, real estate investor in the last couple of years. So the question is, how can the average person become resilient or protect themselves against currency devaluation through real estate? There's no real way to completely protect yourself against hyperinflation or rapid devaluation of the currency, but there are some things that you can do in order to at least have some level of protection. And that is just common sense. Do not over leverage yourself with mortgages. Ensure that an investment property offers enough cash flow, and diversify your real estate portfolio. Again, we're seeing in the housing crash in 2008, 30% of household net worth was wiped out by the bubble, and a lot of people lost their homes. That scenario can at least happen again this time around when economic conditions are just ripe for a crash. And ensure that if you are an investor, do not over leverage yourself with all your investment properties to buy more. Just ensure that an investment property provides enough cash flow. Make sure you have a lot of equity possible on your investments, and diversify, because different areas have are affected differently during a recession.
Yeah, I definitely agree with what you said there. I think you provide some really important insight, especially since I think a lot of people think the dollar actually got stronger when they basically raised interest rates, but that appears not to be the case, as you've shown. I guess that is just a myth, because you've shown that the real estate market and everything, goes down. So could you tell the viewers a little bit about your channel and everything that you're doing?
Yes, well, I just started a real estate channel, just providing trends and some information for homeowners and home sellers and whoever's looking to buy and where to invest. I'm a big fan of vacation rental properties. I think they provide a really good revenue compared to full-time rentals, and you don't have to worry so much about evicting tenants. So just a little bit of information. I just started. I hope to continue, but my main focus is to talk about what's taking place and the issues at hand that are affecting our economy, and also our property rights. We want to protect our property rights.
Yeah, I definitely agree with you on everything you said, and I would just like to say thank you for coming on the show again. And I would like to say a big thank you to all the viewers who are watching this video. I hope you all have a good day, and thanks again for watching. God bless.